Hi, this is Randy Finney with Right Side of the Chart, and this is video number 2 for Thursday, May 5th, 2022. It is 12:17 p.m. Eastern Time, so we're about halfway through the trading session, and definitely worthy of another update today. Hopefully you watched the one I put out earlier. In fact, I was starting to work on that one this morning for the bell. Then I saw the reversal, so I tried to get that post out to you guys where we'd fallen down to support on QQQ. So that reversal for me didn't work out, and then we went on. Somebody asked, made a few replies to that under that post. You might want to check out. So we took out 317 right there. That's pretty much it now. So I stopped out. I went back in. I went in short, and now I'm back long, just for a micro bounce. And here's the thing: this bounce, I'm not heavy long. This bounce is either going to pan out or not. This is several reasons I wanted to do the video, show you. I tell you often I trade the 5-minute chart actively for day trades and stuff, and that has, works out well. You just look for the same kind of things you look for on a daily or a 60-minute chart or even a weekly. You look for these divergent lows. You look for trendline breaks, falling wedge breakouts, rising wedges. Divergent high right here. So a couple things happened today, after that divergent high dropped. This is where we were yesterday when I sent that post out, when both SPY and QQQ were at resistance. And boy, did they reverse it off that resistance. So first of all, we faded the entire Fed rally, which is technically significant. And also, we put in just recently a 5-minute divergent low. So I think we're down. We were down at that point 5% on the day. Usually on a bad day 3%. There's no hard number. We still have a little room to go before circuit breakers would fire off, and I don't think that's going to happen today. But we could be right around the corner from that. So here's what to watch for. Number one, we just put in a divergent low for the first time today on that 5-minute chart, and that's usually good for a tradable bounce. Where it goes is what I'll be watching for today. I'm just going to trail it up, see how far they can run it, and then just start trailing stops up along the way. If the bulls are victorious, remember, it is still D week. D-Day, D-Week, whatever you want to call it, through tomorrow. We'll see what happens, if bulls or bears win. Right now, the bulls are pretty much holding the line. We're right back. There's that 317-ish level. That was the previous reaction lows. We danced on it there. We had a little whipsaw through it, recovery, but then we broke down today. So this level, if the bulls can recover this, they've maintained above that previous low. So now that becomes really the hard line, the most important level, I should say, because now we've traded through 317, which were those previous lows, quite a bit. So it is certainly not over for the bulls, although this hard fade is not ideal bullish action. Ideal bullish action would have been that scenario I laid out on the 60-minute chart here, where expected a pullback because we were near term very overbought. Rallied right into resistance. So that would have been, that scenario I laid out yesterday would have been ideal near-term bullish. Again, nothing's changed as far as my longer-term outlook. I still do not expect, nor did I yesterday, that we'd go on to new highs. Anything's possible. We could. I'll let you know. You know me. I will pivot on a dime. And let you know my thoughts as soon as I do. But that would have been ideal to see the bulls step in there and buy it up at 322.91, pretty decent resistance. And if not there, at least at 318. What they've done now is they've come in and made a back test or a slight overshoot. Remember, in days like today, when you're down 5% and it's straight down, it's pretty much a straight drop, you get it's more than common to see what I call momentum fueled overshoot. So this may be a momentum fueled overshoot of a back test of the trend line. What do I mean by that? If you followed me for a while, you've heard me say it 100 times, but I use the analogy like a baseball catcher's mitt. A major leaguer throwing a fastball 100, 90 something miles an hour. It's going to hit that catcher's glove. His glove's going to snap back. His wrist will snap back from the momentum, and then it'll shoot back forward and come back to the point where the ball first hit, and that's what a momentum fueled overshoot is. You don't get that when you're kind of zigzagging slowly down. You tend to bounce right off support when you hit it, but when you have a near vertical fall, you tend to overshoot support, and then the buyers step in. So look, Right now, if that turns out to be a low and the bulls can take it up here, they've got plenty of work to do. They've still got now a mountain of resistance. This level that I gave you yesterday, 329.80 and QQQ, and the comparable level in SPY, I'll get to that in a second, is even much more significant now than when I pointed it out. Well, why is that? Well, when I pointed it out, we had two distinct reaction highs. Now we have not just three distinct reaction highs, but an impulsive rejection off that level. So that becomes a big level now. We'll color it up, whatever color you want. My chart's going to start to look like a rainbow, but that's a big level the bulls need to take out. Bears are in control under that, or we'll still say it's D-Day. You know, we're battling bulls and bears. It's anybody's game, so it's still D week. If I have to extend D week until next week and, you know, come up with some other convoluted name, D2 week period, whatever, it is what it is. There's no resolve yet or resolution here. They're fighting hard. Bulls had the advantage yesterday and defended the beachhead strongly. Fended off the bears, but then the bears fired back today. And one of my posts, I said, the bears took Omaha Beach today, and if they can take out the recent lows, they're going to take Juneau Beach, and then that's it. I think there were, I don't know, half dozen, I forget how many beaches when they, during the D-Day invasion. And once we got them all, then the Allies were victorious on that battle. And then went on to take France and went from there to win the war. So it was a pivotal battle, and that's why I'm using that analogy now. So let's see where we're at. So there it is. 5-minute charts, QQQ. Positive divergence on the 5-minute chart for the first time in a while. We need to get back up above 315, 316. Here's what I think is going to happen. I think the rally is going to be relatively minor. I think we're going to close pretty darn red today. And we're getting to the point, and I don't want to be dramatic, but you just need to be prepared. We're getting to the point where you could get into that meltdown mode. As much as we've seen some pretty powerful down days over the last few months, or really since November, since the NASDAQ 100 peaked, you have not seen waterfall, what I call waterfall selling. This in itself is waterfall selling today, but one day doesn't make a trend. I'm talking when you get this day after day, when you get days that the circuit breakers kick in on the indexes, that's when you know you're at that period. And why might it happen? Well, let me first show you SPY and then I'll get to it. Well, the why isn't everything I just covered in that last video earlier today. Let me just, before I move on and tell you what's going on here, I want to look at bonds and some other things that are red flags to me today. You have the S&P 500 also. See that little 5-minute divergent low right there. Minor support, not much, but support for 1150-ish. And you're still above the recent lows. So, it's still anybody's game. One thing that we know for certain, we all have our opinions, and we're either going to be right or wrong. And the important thing is when wrong in trading, don't be too wrong. That's, in other words, use stops. Limit your losses when you're wrong. Don't hold a losing position, hoping and praying it'll come back and let your losses bleed. And when right, capitalize on that. Hit it hard. I like to hit it, right now. Can't be too aggressively long or short because it's still anybody's game. You can see here from the daily chart, SPY, they're holding the line. The line, level is 411-ish right there. Previous reaction low in S&P 500. Tested it there, a little whipsaw the other day, only to recover it. And so you still have that bear trap in play right now, believe it or not, for the bulls and bears. I mean, until they take out the recent lows, right now, doesn't look like it today, but the bulls are still in control because they're still above the recent lows and still holding those key levels again, which is 411 in SPY and kind of slipping right now, 317 in QQQ. So QQQ starting to break. Looks like that's probably going to happen. Okay, what other than those levels and how to trade it? What I'm seeing today that is very concerning, and I talked about this in the last video, and I talk about it all the time, is the way the markets work. There's two big components that could come into play here. One of those is margin. I don't have it on me. I should have Googled it. You can Google a chart, NYSE margin debt. And towards the height of any bull market, margin debt reaches extremes and record highs, usually with each bull market top. In margin debt, for those of you not familiar, when you open an account with a brokerage, you can sign a rehypothecation agreement, which allows them to then lend your securities out. And that's called a margin. You have a margin account. And they lend your securities out to others. What are they doing? They're lending your Apple shares to someone who wants to short Apple, or your Ford or IBM, whatever it is. And with a margin account, you can also short. Because when you short, you're selling a stock you don't own. You short, XYZ. You don't own any XYZ. You're betting it's going to go down. So you're selling somebody else's shares. You can't just, that's a naked short. You have to short shares that are there somewhere. And that's what your broker does. They borrow shares and then you short. And then when you want to cover your short, hopefully it's profitable and you buy those shares back at a lower price. So it's really buying and selling in reverse. It's like being long in reverse, except you're selling first and then buying those shares at a later price, right? Hopefully that makes sense. You need to have a margin account to short. And so now the thing with a margin account, many use it for short selling, but more so, the much more common use is the leverage afforded. By having a margin account, your broker will allow you to borrow money from them in order to buy stock with money you don't own. And that the rates will vary. There are exchange minimum sets. Some brokers will tweak those levels at time to time, but pretty much if you're buying stocks, you put $100,000, the broker will let you buy 400,000 or whatever it is in stocks. If you're trading futures, you can do a lot more than that. You can buy, with $100,000, you could probably control $1 million or more. Depends on the contract, and it magnifies your losses. So what happens in a bull market? As stocks go up, more and more people become emboldened and they buy more and more on leverage. They're saying, well, heck, I made X, 10, 20% in QQQ last year on my $500,000. Why don't I load up and buy some more on leverage? And that's what happens. And then what happens in a bear market, and we're always going to have them, is the unwinding of that debt bubble. And that is why bear markets are usually very powerful, and stocks usually fall fast and wipe out in a matter of months, usually wipe out years of gains. It's common. So where am I going? I know it sounds like I'm rambling. Well, that is a real risk. And when does that risk come into play? When do you get a margin call from your broker? Number one, realize that at just about any point in time, the vast majority of investors who are using margin are using it to buy or hold long positions. So when the margin bubble bursts and the market volatility, which is when markets start going down, they hit a flash point, and then it's a vicious cycle. You go down, you have a 5% down day. Let's say those that loaded up on stocks yesterday because of the breakout and the bullish, perceived dovish Fed comments, and they loaded up. Well, when the market drops in 5% or QQQ and Apple is down 5% right now, and Microsoft's down 4.3%, and Alphabet's down 4.5%, and Amazon's down 7%, this is what happens. And your broker gives a margin call. That margin call is going to come, well, it could come intraday, but usually no later than by the end of the day. Some brokers, the old school ones, will send out, give you a little time, maybe not even that day, but others, the more modern brokers like Interactive Brokers, there ain't no, hey, please, send some money into your account or sell some stocks. Either you do it or we will. And then those forced margin calls start hitting usually a little bit before the close. So that's one thing, just kind of a heads up, guys, that what can cause, and this is what I'll be watching for, it would mesh with that scenario, what happened back in 2008 after, remember, we had almost an identical setup where you took out the recent lows, the recent double bottom lows, not to mention in QQQ, right before the Fed meeting. Market liked what the Fed was selling, had a big rally, and then that rally was faded. And then shortly after the fade, the market continued lower. Once it took out those previous lows, it never looked back. And I showed you that's where the biggest wave of selling in the last bear market came. Look, Up to this point, it's certainly a coincidence, and it may just be that. And like I laid out, there's a lot of differences in the macro right now, so we could certainly do this. It's anybody's game. But what happens is, the market, view it this way: the stock or the stock market, it's like a rubber band, and when that rubber band gets stretched, typically the more it gets stretched, the more it's going to snap back when you let go. But what happens if you stretch a rubber band too far? It breaks, right? And that's kind of what happens with the stock market. That's why you have those P3s, those primary wave threes, which are the biggest. It usually comes after the first wave down, then a counter trend rally, and then in a primary five wave pattern, whether it's bullish or bearish. It works the same in reverse. Wave 3 is always the most powerful, and that's a big reason why. Okay, so now I talked about your broker giving you a margin call. But guess what? Guess who has a lot more money in the stock market than you or I? It's hedge funds, pension funds are ginormous, a lot of institutional funds. And so what's going on today, and this is odd, and I'll tell you I'm sticking with these for now. My longs on the Treasury bonds are down, and they're down quite a bit now. TLT was the only one, the 30-year was coming up to, but hadn't yet hit that, where is it? Oh no, TYX, the yield, was coming up to, but hadn't yet hit, and now has hit that long-term downtrend line. I'm talking the primary bear market downtrend line in rates, interest rates. So TYX has hit it. It's actually starting to break out above it. This is a monthly chart, so I will bet you good money that the monthly, that's just a momentum intra-month pop, and we close down. I don't think we're going to keep going up, but I want to show you a few other things. TNX, 10-year, same thing, but TNX, remember, it popped the downtrend line. I mentioned that last month, but it also has big resistance right here. So these yields are still at, I told you before, I was giving these bonds some room. They're at long-term resistance. And okay, so what does that have to do besides my positioning? It should be, diversifying and working against or helping. Well, when you're short the stock market and long bonds, that's not a diversified trade because they tend to move together. But let me talk about what's happening here. Okay, earlier in the previous video, I talked about the old rule of thumb, gold standard asset allocation model of 60-40. Now, again, that can vary, but this is typically what pension funds and things like that will use. Pension funds, and I'll pick on CalPERS, they're the largest. California pension fund for teachers, public employees, firefighters, I believe police, all that part of CalPERS. And CalPERS, like many majority of pension funds in the U.S., is grossly underfunded. They have to a certain amount they have to pay out to retirees, and then what they currently have in. And in recent years, they've been increasing their equity allocation to try to play a game of catch up, and it's worked well so far. I don't know where they're at in the most recent ones, but this is what doesn't work. When both stocks and bonds, which if you've read about, this is 2021 here, both are having their worst quarter, and this is very unusual. So again, I talked about it in the previous video, and where it has to do with maybe a fund blow up or something along those lines. Okay, sorry I paused the video. I wanted to close out those longs. I don't have a good feeling here on this. I think we're gonna see some margin call selling, forced selling today. Okay, back to my point. And pardon me if I'm being a little long-winded on this. So where I'm going with this is they have institutional investors get margin calls as well. They're holding their securities with a broker, and even those that don't, depending on how they're set up, they have certain safeguards and risk parameters that they have to check. They can't pray and hold. The retail investor does buy and hope, they call it. Instead of buy and hold, they buy in hope. When their Apple starts going down and it drops 10%, they think it's a correction. When it goes down 20, they say it's a bear market, but Apple always comes back. But guess what? Every now and then, including in the last bull market, Apple drops 40%. These are all bull market corrections. 40, 34, 45 back here in 2012, 13, 62% in the last bear market, 42, 83. And I'm just picking on this. I'm using this as an example. So buy and hope, they ride it out. And usually those people usually capitulate there. But CalPERS and your mutual funds, in certain funds that they have a fiduciary responsibility to their investors, including hedge funds, they don't have that option. Now, a hedge fund tends to run with a high degree of leverage. They can outright blow up. And when they blow up, that's ugly because then it can have a ripple effect in the financial system. But the pension funds, their normal cushion of bonds isn't working. They're down. They're having the worst quarter in a long time in the stock market. And they're also at the same time having the worst quarter in bonds, when bonds should be doing this and offsetting that. So these are some of the things. And it ties back into the comments I made in that earlier video today, because I have been making a point to read up and tune in and hear what all the talking heads are talking about. And their case is that the economy is on very solid footing. And at best, we're going to go through an adjustment. And yeah, there may be a little more downside, and that's it. Maybe not. And they're accumulating stocks, et cetera, et cetera. I don't think they see the risks that I do. And it also kind of meshes with what the charts are saying. If that scenario that I laid out earlier today plays out, then that's it. And then you'll hear about it. And then, oh yeah, well, who would have known that blah 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 would blow up? XYZ hedge fund would blow up, or that CalPERS would blow out 10% of their equities positions, or they need to hedge up and buying put protection, and all of a sudden then that causes selling and movement in the market. So hopefully that makes sense, guys. And we're right at that edge. And again, it goes back to what I've been saying for 1 week now. And I'm either going to be right or wrong. Maybe I'm wrong in both ways. As far as this is a critical technical juncture, hence the reason I named it D-Day, D-Week, or at least this test of this level, because we've already had it a few times. Anything's possible. We could bounce and test it again. But I think it's make it or break it time right now. And, if they break it, based on everything I just said, forced margin selling from both retail traders and institutional traders, as well as institutions shoring up their losses and trying to hedge up and plug the leaks, because they can't sit there and watch losses comparable to what we had in the last bear market from this same point, not the top. The top to bottom was 56 or something percent, but from when the markets broke in 2008 and had that final leg down, it was still another 43%. Back in 2000, from high to low, the NASDAQ fell 50%, got chopped in half. No, sorry, 83%. What am I saying? I was looking at the annualized number. You can see roughly 83%. They can't afford that again. So that's where we're at. I don't think these 5-minute divergences are going to play out. We got rejected so far right on the first resistance levels, downtrend line. And it's getting now, it's not late in the day, but at 12:40 p.m., they haven't turned this thing around. They're probably not going to today. So as much as we're already down, we're down 5% right now. Anything's possible, and that's why I get these videos out. I do them ahead of time. Watch, if they can run it back up here today and park it comfortably away from the lows. But remember, each time we threaten these lows, even where we're at now, we're starting to crack below my yellow line at 317. Then I put back that what I call crash warning. Remember, I use the analogy between hurricane and tornado, the watches versus the warnings. Whereas, I had a warning back here. Didn't say that I didn't say we were going to crash. I just said the odds were higher if we would have took it out, but we didn't. And then I removed that down, put it back to a watch. And then as we started getting lower recently, I put it back to a warning, and we are most certainly on a warning right now. And a crash warning just means a quick down. You could see anything. Europe had a flash crash the other day. They don't know. I don't know what they finally figured out. They figured it might have been a fat-fingered trade from a institution, but a lot of the European indices experienced a flash crash the other day, and this market is run by robots nowadays. I think you guys all know that. It's all the algos and high frequency trading programs take over. So, all right, I could talk forever. Let's see where we end the day, and then there's always tomorrow. If they park it, somewhere in close proximity, we still have tomorrow, and then you have Friday. And my guess, I always try to put myself in the head of everybody else out there, because when you're trading the stock market, it's really, you need to get in the head and the psyche of the masses, the majority. More buyers at any point in time, market goes up. More sellers at any point in time, market goes down. So I'd like to know how many longs are going to go home comfortably, how many bulls are going to go home comfortably long if we end the week down here or somewhere there. Likewise, if we rallied up by tomorrow and we get back above or at 320, maybe you can see some more short covering. So anything's possible. But right now, with bonds being down as much as they are today, gold's falling, this to me is indicative of maybe a margin, early margin unwinding, because usually you don't see that. You don't see the stock market down, QQQ down 5%. By the way, S&P down almost 4%, and then the long bond TLT down 3.6%. Where's your safe haven? Gold's down 0.5%. And I'm sticking with the gold and treasury. I want to let you guys know that, because if my scenario is right, of course I showed you the long-term bonds are long-term rates are still at resistance, which means bond prices are at or near support. And again, I'm looking at a monthly chart. That's why on the daily, a big 3% drop doesn't really, shake me out. But if we do break down and the markets have a hard fall, you're going to see two things. You're going to see, number one, or likely, I can't guarantee it, you should see institutions flock into treasuries as a flight to safety bid, like I talked about. CalPERS, where are they going to put that money if they've got a ton of stocks? They're overweighted in equities right now. That's a tremendous amount of risk. They can't afford a huge loss, and there's no way to get it back. Again, they have a fiduciary responsibility, to all the employees. So if you see that, you'll probably see a flight into treasuries if the market breaks down, the flight to safety bid. And the other aspect is, if the stock market breaks down, that's going to indicate that future economic growth expectations have just took a pretty swift dive. I'm watching the economic indicators, and they are slowly but steadily and pretty consistently rolling over. Yes, the economy is still strong by most metrics, but I don't care. I don't look in the rearview mirror. I try to look ahead. So, if the economy does this, or even there's the perception it's going to do this, which is always, it goes in line with the stock market. The stock market drops another 10, 20%. I promise you're going to hear economic expectations go down. And therefore, inflation expectations will go down along with it. And with that will long-term interest rate expectations. So rates go down and then bond prices go up. So right now, more than ever, I think treasuries look really good, especially if you are a bull and you're saying, Randy, you've been telling me about this whole big drop for a long time, but it hasn't happened. Yeah, we're down, but it's only correction. Let's say you're that, and you have a ton of stocks, right? And you want to hedge up. And you don't want to buy puts, because right now the VIX is soaring, so put protection costs a lot more. You really can't wait to buy puts. This is not the time to buy puts. The time to buy puts was right here, and was right here, and here, and here. That's when you hedge up. It's just not worth it at this point. So if you want to hedge up, it's not a direct hedge, and lately they have not been running inversely to one another. I'm talking about stocks and bonds, but I think you buy treasury bonds to hedge against a stock portfolio if you don't want to let go of your Apple because of long-term embedded gains, or Alphabet or Facebook, whatever you're holding. Then I do think that treasury bonds will most likely going forward provide a hedge in case we do have the markets do break and have a strong sell-off. And keep in mind, if you hedge, it's not dollar for dollar. You buy $100,000 of treasury against a $100,000 position in QQQ. If QQQ drops 20% from here, you're not going to make 20% on your TLT. So you need to put more in there. If it does, you might make It's hard to say. It all depends. I'd have to look at the chart and study that and give you a target. But there's one that is actually a potential bounce target for TLT, and it's about 16% higher up to this resistance level. So let me end the video, get it out to you. There's my thoughts. As of now, I would give at least undoubtedly a check mark to the bears today. You know, I do my little play-by-play thing yesterday, and over the last few days, the bulls certainly got a check mark for when they took down the markets below support. I'm sorry, yeah, when after it had dropped from support and they recovered it, and then yesterday when they started to walk it away from that level, they got a check mark. But today the bears get even a bigger check mark because they faded that rally 100% and then some. Okay, all of it and then some. And they've also got QQQ back below 317. Now they just need to break spot. They need to hold that, number one, hold the line, and we need to see SPY lose that 411 level and then those recent lows, and then boom, should be all good to go. All right, guys, I'll wrap the video up here, get it out to you, and yeah, we'll see what happens by the close. Maybe I'll get another one out, but this is what I'm focusing on right now, mainly the equity markets, and still, like I said, hanging in there, not adding to, but hanging in there, sticking in with my gold, silver, and treasury bond trades now. This has been Randy Finney with Right Side of the Chart. Have a great day.